Hello again, I'm your instructor Daisha Russell, and today we're going to talk about account types and financial statements. Recall the basic accounting equation, assets equals liabilities plus stockholders' equity. If you've taken an accounting course in the past, you may have referred to stockholders' equity as owner's equity. We use owner's equity when we're working with sole proprietorships and partnerships. We use stockholders' equity when we're working with corporations. The owners of a corporation are called stockholders or shareholders. Stockholders' equity can be broken down into contributed capital and retained earnings. Contributed capital is the capital contributed by the owners into the company. So that might be things like cash or equipment. And in exchange for those items, the corporation gives the owners shares of stock. That is a share of ownership in the corporation. Retained earnings is the earnings retained in a company at the end of a period. Retained earnings can be broken down into net income minus dividends. Net income is the revenues of the period minus the expenses of the period. Let's talk about those account types. First up, we have assets. Assets are the resources a company owns or controls. There are many different types of assets. A couple of good examples of assets are cash, equipment, supplies, and accounts receivable. Next, we have liabilities. Liabilities are the creditor's claims on assets. We can think of this as the amount that the company owes to its creditors, similar to a loan. Then we have stockholders' equity. Stockholders' equity is the owner's claim on assets. As we said on the prior slide, stockholders' equity can be broken down into several parts. The first component of stockholders' equity is contributed capital. These are the owner's contributions to the company. Oftentimes we will call this common stock or preferred stock or another type of stock. We may also call it additional paid-in capital. Dividends are returns of the company's earnings to the owners. So at the end of the period, the company will look at how much money it has earned and decide whether or not to keep that money in the company in order to grow the company or to return something to the owners. Dividends can be in the form of cash, stock, or property. Revenues are the increase in assets from a sale of a product or service. And expenses are the cost of assets consumed or services used to generate revenues. You can read more about these account types in your textbook. I will also post an additional video about these account types. Here's a helpful hint. At the back of your textbook or at the end of your e-text, there is a chart of accounts. This chart of accounts lists all of the different account types that you might see while reading the text or doing your homework.